Tesla just signed on to what could become the largest distributed power plant in the country, a partnership to pool more than 16 gigawatts of flexible electricity and sell it straight into the AI data center boom. We've also got a newly unveiled mass production robotaxi from one of Tesla's competitors, a startup launching a $25,000 electric pickup, a top safety award for the Cybertruck, and more. This is the Tesla Brief, after the close on June 24th. Welcome to the show. A quick look at the stock. Tesla closed down 1.8% at $375.53, while the Nasdaq fell about 0.4%. And the S&P 500 was close to flat, down around a tenth. So Tesla lagged the broader market today, and there wasn't any company-specific news behind it. This looks like more of the week's pullback in the big AI companies, plus Tesla's usual swings, than anything Tesla itself did. Let's start with that power plant partnership, because it's the most important thing Tesla put its name to today. Tesla teamed up with two other companies, Sunrun, a big home solar installer, and Renew Home, which manages smart thermostats, to build what they're calling the largest distributed power plant in the United States. More than 16 gigawatts of what they term flexible power capacity. Now, distributed power plant sounds technical, so let's unpack it, because the idea is simpler than the name. A normal power plant is one big physical thing, a gas plant, a nuclear reactor, that you build over years and that sits in one place, generating electricity. A distributed or virtual power plant is the opposite. Instead of building one big thing, you take hundreds of thousands of small things that already exist. Home batteries, electric cars plugged into garages, smart thermostats, and you link them with software so they can act as one. When the grid needs power, you pull a little from every home battery at once. When the grid needs to shed load, you nudge millions of thermostats up a degree. Pulled together, all those tiny adjustments add up to the output of a giant power station, without anyone pouring concrete. The number here is the headline, more than 16 gigawatts. To put that in perspective, that's roughly the capacity of 16 large nuclear reactors, except it's assembled virtually, out of equipment already sitting in people's homes, rather than physically built. The pitch the three companies are making is speed. This is, in their words, deployable in months, not years, against new generation that takes years to permit and build. And here's why it matters specifically for Tesla. The buyer they're aiming at is the AI data center boom. Those data centers are the fastest growing source of new electricity demand in the country. And they need power faster than new plants can be built. So this partnership puts Tesla's home Powerwall fleet, and potentially parked Tesla vehicles down the line, into the same business as the Megapack, selling grid services into that demand. It widens the customer base for Tesla's energy arm, from utilities to the hyperscalers building AI. That's a meaningful expansion of where Tesla Energy can earn money. And it's worth watching how much of that 16 gigawatts actually gets contracted and dispatched. Because an announced number and a deployed number are two very different things. Now, the reason that demand is so real showed up after the close tonight from a completely different company. Micron, one of the biggest makers of memory chips, reported earnings and blew past expectations. Revenue up sharply, margins well above what analysts looked for. But the line that actually moved its stock, up around 12% after hours, wasn't the past quarter. It was the company saying it expects to stay supply constrained into 2028, with no clear view of when supply catches up to demand. Customers have already locked in roughly $22 billion of deposits and commitments just to secure future chips. Gene Munster at Deepwater called this a significant positive for the AI trade, and evidence that demand could outpace supply into late 2028 or even 2029, adding that it's, in his words, hard to believe. Here's what it means for Tesla, and it cuts both ways. Tesla buys memory chips for its training computers and for the AI hardware going into its vehicles. A memory market that stays tight for years means higher costs and ration supply for everyone scaling AI, Tesla included. But it also validates the demand side of the whole AI story, the same surging electricity demand that makes today's 16 gigawatt power partnership timely. It's worth sitting with the contradiction. Tesla is now selling into the power shortage side of the AI buildout, while buying on the chip shortage side of the very same boom. Onto robotaxis, where Tesla got a new competitor headline today. Amazon-owned Zoox revealed the version of its purpose-built robotaxi that's going into mass production at its factory in Hayward, California. The company claims it can ramp up to 100 vehicles a week there, subject to regulatory approval, which works out to roughly 5,000 a year. The vehicle has no steering wheel and no pedals, drives equally well in both directions, and seats 4 passengers facing each other. Zoox says it's given over 500,000 rides so far. Why does this matter for Tesla? At a facility that's running today. But the missing context is important, because the two companies are arriving at no steering wheel from opposite directions. Zoox is building dedicated hardware, backed by Amazon's balance sheet, and has spent years working through regulators to operate in California and Las Vegas. Tesla's approach is software first. Its robotaxi service runs on regular Model Ys with full self-driving, and the fleet is still small, around 20 active vehicles, all in Texas. One side is scaling custom hardware, the other is scaling software on cars it already builds by the millions. Whoever puts the most paid riders on the road first will set the unit economics the other one has to beat. So this is a real competitor making real progress, and a useful reminder that Tesla isn't alone in the purpose-built robotaxi race. Staying with competition, but on the affordable end of the car market, a US startup called Slate Auto formally launched its small electric pickup today at a starting price of $24,950, with an SUV version at $29,950, and first deliveries promised for the fourth quarter of next year. The specs are modest and honest, around 205 miles of range, 0 to 60 in about 8 seconds, rear-wheel drive, and a 10-year battery warranty. The company says it has 180,000 reservations and capacity to build 150,000 vehicles a year at a plant in Indiana. The business model is unusual. The base truck is deliberately stripped down. They call it a blank slate. And then you add from over 200 accessories, most under $500, with no traditional dealer network. If that direct sales, build-it-your-way approach sounds familiar, it should. It's straight out of Tesla's playbook. And Slate's leadership includes former Tesla and Amazon people. What it means for Tesla is the price point. This is the first credible attempt at a sub-$30,000 electric truck in the US. The affordable tier Tesla has talked about for years, with the cheaper Model 2 and its so-called unboxed manufacturing process, but hasn't actually delivered. Two caveats to keep this honest. Reservations are not sales. A refundable deposit is a long way from a delivered vehicle, and EV startups have a long history of missing their own targets. And some of the Tesla bulls who turned up enthusiastic at the launch are themselves investors in Slate. So weigh that accordingly. The broader pattern is the one worth holding on to. Every time someone serious enters the affordable EV space, BYD globally, now Slate at home, Tesla's own lower-cost timeline gets a fresh comparison point. A clearly positive item next. The Insurance Institute for Highway Safety, an independent crash testing body funded by the insurance industry, updated its 2026 ratings and named the Tesla Cybertruck the only pickup to earn its top award, Top Safety Pick Plus. In the pedestrian crash prevention tests, the Cybertruck avoided every single staged collision: a child crossing the road in daylight, an adult crossing at night, and an adult walking alongside the road at night. Tesla's official account amplified the result, as you'd expect. The context the headline doesn't volunteer is what makes this notable. The Cybertruck has drawn repeated safety questions since launch, from early concerns about its structure to some well-publicized recalls. This rating is the closest thing to independent, third-party validation Tesla has gotten on the vehicle, and it lands at a pointed moment. Tesla spent this week defending its broader autopilot crash record after a release of Texas crash data. Tesla's argument, across both, is the same: that its camera and software safety approach is measurably better than what's on the road. The difference here is that the IIHS rating is the one piece of that argument Tesla didn't write itself. A quick word on the wider market, because there's a genuine Tesla angle inside it. Ed Yardeni framed this month's stock weakness around a few things hitting at once: a Fed more inclined to raise interest rates, fresh doubts about the AI trade, and a sharp drop in the price of oil, with Brent crude falling below $77 a barrel. That oil move is the part that touches Tesla, and it does so in a loop worth understanding. Part of why crude is falling is that China's switch to electric vehicles is eating into its gasoline demand. JP Morgan data has China accounting for nearly 3/4 of the recent drop in global crude imports. Now, cheaper gasoline is historically a mild headwind for EV demand in the US, because the savings from going electric shrink. But the very EV adoption that's softening oil demand is part of what's pushing those oil prices down in the first place. Tesla sits on both sides of that loop. There's also a PCE inflation reading out tomorrow morning that the market is watching closely, but that's a market-wide swing factor, not a Tesla-specific one. I'll close on something that's less about Tesla's business and more about Tesla's shareholders. And it points straight at next week. The talk this week about a possible SpaceX public listing has the Tesla retail community having a conversation it hasn't really had before. SpaceX just priced a large debt sale, and the chatter about an eventual IPO has focused less on how the company is valued and more on the unusually large share, around 30%, that would be set aside for everyday retail investors. Why does that matter for Tesla? Because for the first time, the most loyal slice of Elon Orbit capital, the small investors who've stuck with Tesla through every swing, is being asked to choose where their money goes between Tesla and SpaceX. How that conversation lands could shape how Tesla's retail base behaves heading into two real near-term events: second quarter delivery numbers, which land next week, and second quarter earnings in late July. And there's a quieter, more concrete data point underneath the IPO noise. SpaceX's new 5-year bonds priced at about 5.35%. And that number, more than any IPO speculation, gives the market a clean read on what borrowing actually costs for an Elon company at SpaceX's scale. That's the kind of figure analysts use when they try to model how Tesla might finance its own AI infrastructure ambitions. So the question to carry into next week isn't really about SpaceX's listing date. It's whether Tesla's own delivery numbers give its shareholders a reason to keep their attention and their capital right where it is. That's the Tesla brief for today. If it's been useful, please subscribe. Thanks for joining us, and we'll see you in the next episode.